welcome back. I'm really glad you're sticking with this because this video is going to illustrate three very important issues. And the first issue is what happens if one of the simplifying assumptions simply isn't true. You remember that previously we had assumed that current service costs, that any benefits paid, and any contributions all happened at the end of the year, or near the end of the year. In this instance, the company is going to make their annual contribution on July the 1st. I'm just doing that so that you can see how that affects your calculations. The second issue is what happens when the plan assets are not earning the amount that's been stated. Here we're looking at a 10% earning plan. What happens if they don't earn 10%? What happens if they earn more than that or less than that? What happens if the plan assets actually lose value? Those issues have yet to be dealt with, and we're going to deal with them in this video. And then finally, we're going to look at what happens when the defined benefit obligation is revalued by the actuaries. So here we see this defined benefit obligation of $212,700, but I'm hoping that you remember from your previous reading that that number is actually an estimate of the present value of the future cash flows, and it includes a whole lot of estimates. It includes determining how many employees you've got now and how long they're going to work with you and how much they're going to contribute to the plan based on their current earnings and how long they're going to live and when they're going to retire and will there be any benefits paid to survivors. And whoa, your head could explode at this point. But luckily that's the work of the actuaries. We don't have to worry about it. The actuaries will tell us if they have determined a new amount for our defined benefit obligation. So we'll see what happens when we get that information. But first things first, back to the beginning, we're going to record the plan assets and the defined benefit obligations that were in place at the end of last year. They are always the opening balances for the current year, and we can see that at the end of last year we had underfunded our plan by $78,600. So let's see what wonderful things happen this year. The first thing is that we can see that the current service costs were $13,000, and we're going to just enter that right there. And that, of course, is an expense to us, and it increases the defined benefit obligation by the same amount. We're going to take a look at the interest costs here. We can see that there were no other changes. In a previous example, we saw that there were past service costs that had been determined at the beginning of the year. Here there's no other adjustments to that number, so we can just take the opening balance at 10% and put that in. In itself, just want you to note that in itself, that would be an expense. If there was no interest earned on the plan assets, then the expense would be that full amount. If the plan assets had declined in value, we would have additional expense. We're going to take a look at what happens when the plan assets are performing differently than, in this case, than at 10%. So let's just hold that thought for a minute, and we're going to take a look at the contribution to the plan. We know it's a credit to cash of $24,000 and a debit to the plan assets. And remember that that all took place on July the 1st. Now, let's calculate the amount of interest that goes in here. Previously, we had just taken the opening balance at 10%, and coincidentally, that had always been what they'd actually earned. But this time I've got to take the $134,000 at 10% plus $24,000 at 10%, but for 6 months. Does that make sense? The contribution was made on July the 1st. Remember that. So that means that during the year in the plan, there was $134,100 for the entire year at 10%. And then there was $24,000 in the plan for 6 months, also at 10%. So that's $14,610. So here, this amount of expense is reduced by that $14,610. So we have an annual pension expense that results from the difference in those two numbers, the $6,660. That's exactly the same as we've done previously. The only difference is the plan assets actually only earned $12,000. So we have to put an adjustment in here for the difference. What I have now is that the sum of those two numbers equals the actual earnings in the plan. Remember that this is a memo record and we're reflecting what actually happened in this plan. So we can't just put in a number we'd like, we have to reflect what actually happened. And this is just how we do it. This $2,610 represents a measurement loss to us. It's an additional expense, and it's called a remeasurement loss. Now, I have here just shown a slightly different calculation, same thing, just showing interest calculated 10%, 14,610, actual interest earned 12,000, so that I've calculated the remeasurement loss to be 2,610. Okay? Different ways of showing the same thing. Let's just get those benefits paid in here, because we know that the benefits were paid $10,500, reducing the defined benefit obligation and reducing the plan assets. Again, that's something the plan administrator would tell us. It's not money that we're paying out. So we've taken care of everything right now, except for one little wrinkle, and that's that the plan administrator has notified us that the actuaries have determined that at the end of the year, our defined benefit obligation is not the $236,470 that's shown there. What it doesn't show you in the textbook is they've actually determined that the plan has a defined benefit obligation of $265,000. And the difference between those two numbers is $28,530. That's the amount that is shown in the textbook as an actuarial loss due to changes in actuarial assumptions. I wanted to show you that because there's different ways this information can be presented in a question. The most straightforward is to tell you that there was an actuarial gain or loss and to give you the amount, but it's possible that instead they could tell you that at the end of the year the defined benefit obligation was a different amount. So here I can see that now with that adjustment that the defined benefit obligation is $265,000. This is a loss and shows as an expense. Bingo. So once again, the blue section tells me what my journal entry is going to look like. I add up the column for the annual pension expense and I credit that to the net defined benefit. I add up the column for the cash and show it as a debit. So these are the journal entries. At the end of the year, we can see that we are now underfunded by $105,400. I'm really starting to reconsider the wisdom of hiring employees and giving them a pension plan. Well, there you go. There's the journal entries. Any second now. And you've now mastered most of the complexities of the defined benefit plan. Everything we've done now has been under ASPE, under the Accounting Standards for Private Enterprises. The next very brief video is going to show you how we deal with it under IFRS. The good news, it's not a lot different. Thanks very much for your attention, and I really hope this has helped.